Mortgage rates just decreased to a 7-month low as U.S. initial jobless claims jumped to nearly a 1-year high, and investors digested Fed Chair Jerome Powell's comments the other day that suggested a September interest rate cut is finally on the table. I have a lot to share in today's video regarding rates, and also share how these decreases in rates are impacting buyers right now. We'll also look at the likelihood of future rate cuts by the Fed as well for the remainder of the year. I have a lot to share in today's video. So with that said, let's begin today's video. Let's first have a look at investing.com's economic calendar to see what happened today, which is on Thursday. So here's what happened. U.S. initial jobless claims. These are for people filing for unemployment for the first time. That was at 249,000, higher than the forecast and also higher compared to the previous reading, which was last week. The significance regarding this is that this is nearly a 1-year high, the highest levels for the week of August 10th last year. So more people are filing for unemployment. Let's have a look at this as well, though. This is the number of people who are continuing to file for unemployment claims. That increased to 1,877,000, higher than the forecast and also higher than the previous reading, which was reported last week at just under 1.9 million. This is actually the highest levels going back to February 29th this year. And here's how the market reacted to this news from Fed Chair Jerome Powell's comments on Wednesday, but also this report showing we're seeing some signs of cracking to our labor market. So as of the early or late morning hours of Thursday, the 10-year Treasury decreased to 3.979%, down 12.5 basis points compared to yesterday. So according to investingpedia.com, as of August 1st, the average 30-year fixed rate decreased to 6.61%. Also, according to the Mortgage News Daily, it fell to 6.62%, down 8 basis points compared to yesterday. Jumbo's at 6.8%, FHA and VA loans at around 6.15%. Now, looking at the daily rate for a 30-year fixed, 1 year ago, we're at 7.10%. So therefore, we're down by about 50 basis points or 49 basis points compared to 1 year ago. So rates lower compared to 1 year ago. And right now at 6.62%, this is actually the lowest rates we've had going all the way back until December 27th last year. So in other words, we had the lowest rates today, which is on Thursday, for the entire year so far. Like I mentioned at the very beginning of this video here, I'm going to share how the decrease in rates are impacting current home buyers right now. So let me just kind of explain this in two different scenarios. Number one, when rates decrease from about 8% that we saw in October last year, now they're at around 6.6%. That's a decrease of about 1.4 percentage points, which means that buyers right now have approximately a 14% increase in their purchasing power due to the fact that rates fell by about 1.4 percentage points. Now, I know what you guys are thinking though, right? Because home prices have increased since October as well, but they did not increase by 14%. Based on my nerdy analysis, looking at the National Associated Realtors median sold price, home prices have increased by about 9% compared to October. So looking at your payment back in October, when rates were at 8.03%, the median sold price was at $392,000. That's according to NAR. Also, assuming an average property tax rate at 1.25%, the purchase price, which is $392,000, you would get approximately $4,900 per year in property taxes. I'm going to share that because the increase in prices caused an increase in property taxes. Not by very much. I think it's about $35. But just to share apples to apples, I want to share this with you guys. So your principal and interest payment plus taxes would be $2,715 back in mid-October last year, when the average rate was at 8.03%. Now looking at today's rates, 6.62%, the median sold price according to NAR for the month of June is at $427,000. Again, based on a 1.25 percentage point rate, which is basically the average rate in California. I realize that some areas like in Hawaii have a much lower rate, but of course other areas such as in Texas and New Jersey have a rate much higher than that. But just looking at average rate, which is probably more or less in line with the national average at 1.25%, you would get $5,338 based on the purchase price at $427,000. And of course, I'm assuming a 20% down payment. Anyways, looking at today's rates, you'd be at $2,631 per month, which is approximately a savings of around $84 per month. So I know you guys think that, home prices are everything. It doesn't really matter what rates are. In my opinion, when we see a decrease in rates, we should see an uptick in home buying demand. And clearly, based on this analysis here, you're going to be paying less for your house today compared to buying a house back in October last year. And that is despite the fact that home prices have increased by about 9% since October last year. Now, don't get me wrong. I'm not saying to go out and buy a house right now. Now is a great time to buy. I'm just saying that it's very hard to time the market. The decrease in rates is positive news for home buyers right now. We have approximately 35% more houses for sale compared to 1 year ago, based on data from Realtor.com. I actually just kind of worry, honestly, that a lot of people think that the housing market is going to crash, that you should wait to buy a house. And I will tell people that it is very challenging to time the market. It's very challenging to figure out what's going to happen because there's so many things that impact our housing market. There's rates, how many people are going to decide to list their house for sale, economic conditions, sentiment regarding the housing market, our economy, etc. So all these things are, external factors that are completely beyond our control. So my advice for you guys, I'm kind of going off on a tangent here, but this is my advice for you guys. My advice for you guys is that do not buy a house unless you do not plan to own it for at least 10 plus years. So have long-term time horizons. Also, have a stable job as well, and also have an emergency fund as well to pay for any unexpected expenses as well. If all those things line up, then why not buy a house right now? Because you could be waiting forever for a housing market crash, and maybe, just maybe, it will not happen. All right, moving on, let's talk about the likelihood of future rate cuts by the Fed though. This is according to CME's Fed Watch tool. They provide the likelihood of future rate changes by the Fed. And of course, the Fed controls the federal funds rate, which is the short-term rate that banks charge each other to lend each other money. It does have an indirect relationship to mortgage rates though, of course, right? So the next meeting is scheduled for September 18th this year, and there's a 79.5% probability that the Fed will decrease rates by 25 basis points. The federal funds rate is at 5.5% right now. So there's a 79% chance they're going to decrease rates to 5.25%. This is much different compared to 1 year ago. 1 month ago. The likelihood of a 25 basis point rate cut was only at 59.8%. Now it's at 79.5%. So therefore, the street is expecting strongly a rate cut in their next meeting. Their next meeting after that is scheduled for November 7th. And then there's a 72% chance we're going to be at another 25 basis point rate decrease to 5%, which is much different compared to 1 month ago when there was only a 25% probability. Their last meeting scheduled for December 18th, a 65.6% probability. We're going to be at 4.75%. So therefore, the street is expecting that we're going to see 3 consecutive 25 basis point rate decreases for the remainder of the year. There's 3 scheduled meetings. In each of those meetings, they're expecting that the Fed's going to cut rates by 25 basis points. So therefore, by the end of the year, we're going to be at 4.75%. Whereas right now we're at 5.5%. This, of course, is all going to depend on incoming data, especially regarding the labor market and inflation numbers primarily. So let's have a look at the economic calendar for Friday. I'm making this video on Thursday. This is could kind of change the landscape regarding rates, or mortgage rates, because we have non-farm payrolls for July will be posted at 5:30 a.m. Pacific Standard Time. So if jobs numbers come in much lower than expected, that could cause rates to decrease further. In contrast, if more jobs are added than are expected, they're expecting 166,000 jobs added. If we have over that number, we should expect, or could expect, to see rates to actually increase on Friday. Also, the unemployment rate is currently at 4.1%. They're forecasting at 4.1% as well. So this is going to be a big report that's going to be announced first thing on Friday. And actually going to be posting today's video on Friday morning at 6:30. So take a look at that, because that will likely impact rates on Friday. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value out of today's video whatsoever, then please hit the like button. Also, consider subscribing as well. I think we're only around 250 subscribers away from 100,000 subscribers on this channel. I just can't believe it. It's absolutely insane. Thank you all for your support. I appreciate you guys so much. Have an amazing day, and we'll see you on the next video. Thank you.